Hello and welcome to Power Breakfast in the Mumbai News Centre. I'm Ekta Batra and with me is Mangalam Malu, and it is Diwali week. It is Dhanteras today, so wishing all our viewers a very happy Dhanteras and a very happy trading week as well. Hi Mangalam.
Hi Ekta, good morning. Yes, we do wish our viewers a lot of health, wealth, prosperity, happiness. But for you, there is double cheer because you are celebrating your birthday as well. Wish you a very, very, very happy birthday, Ekta.
Thank you, Mangalam. Thanks very much. I'm lucky that it's, Dhanteras today.
May it bring you a lot of happiness and prosperity as well.
Sure.
Double over, given the double nature of celebrations.
Yes, absolutely. And I think it's Virat Kohli's birthday too.
Okay, so we wish Virat Kohli a ton load of centuries today as well. But first up, we have the markets to contend with. A lot of cues to work with all through this week. A truncated week, nevertheless. But first up, all top stories that we're tracking this morning. The US markets end lower on Friday, off the session's lows after President Donald Trump says that the US and China are much closer to striking a deal on trade. Says the two countries will have a good deal in place. The Asian markets, however, weaken early morning trade, awaiting Chinese Premier's speech.
Oil prices fall as US sanctions on Iran oil take effect. Secretary of State Michael Pompeo says the US will grant 8 temporary waivers for countries to keep importing Iranian crude.
The Prime Minister rolls out a 12-point program in a bid to give a fillip to small and medium enterprises. Promises loan approvals in 59 minutes for up to 1 crore rupees through a new portal. Also announces a 2% interest subvention scheme.
Axis Bank surprises the street, beats expectations on most parameters. Slippages at a 10-quarter low drives NII growth to a 10-quarter high, but loan growth at a 6-quarter low is a sore point.
And the big number to watch today will be from State Bank of India. Analysts expect slippages to be at around 14,000 crores, and the bank is expected to report a net loss of over 200 crores. Also watch out for numbers coming in from pharma major Cipla. All right, but before we kickstart trade for our markets, a roundup of all the Asian markets. They're not doing too well. In fact, they've started the week on the back foot as investors remain cautious over global growth prospects. It was a volatile session on Wall Street on Friday's trading session as well. So the Nikkei down by about 1.3%. We did get some macro data from Japan. The Nikkei Services PMI has shown a bit of an expansion at 52 plus. This compares with about 50 month on month. But right now, the street is awaiting a speech from the Chinese President Xi Jinping at the China International Import Expo, where he is likely to speak about trade, and that is on top of mind. But all the other indices, they are fair amount in the red, so the Korean index should come up for you. That one too is trading with a cut. Apart from that, we have the Hang Seng as well as the Straits, both of them sitting with a fair amount of cuts. The Korean index lower by about 1.5%. On the back of this, the SGX Nifty is indicating a cut. However, it is a slight outperformance as compared to the other Asian peers. Also because despite the Iranian sanctions, the kind of exceptions that the US has made in terms of crude export from Iran to a couple of countries, the crude prices are still at $72.50 per barrel, which is okay for the Indian markets. Right now, just a bit of a niggle as far as the other Asian markets are concerned. Just 35 points on the downtake as far as the SGX Nifty is indicating.
Okay, well, let's tell you about the US markets then. Wall Street, in fact, ended lower on Friday as investors digested different comments and reports on global trade. So equities pared off some of the losses after President Donald Trump said that the US and China are much closer to striking a deal on trade, saying that the two countries will have a good deal in place. The Dow ended more than 100 points lower, followed by the S&P 500 that ended 0.6% in the red. Apple shares, however, dented the broader tech sector, with the Nasdaq losing 1% at close. CNBC's Leslie Picker gets us a wrap of all what took place on Wall Street.
U.S. stocks swinging wildly on comments from President Trump on trade negotiations with China. The Dow eventually settling down 109, the S&P down 17, and the Nasdaq down 77. The Labor Department out with its monthly jobs report, the U.S. adding 250,000 new jobs in October, outpacing estimates. Wage gains surging past 3% for the first time since the recession, and the unemployment rate remaining at 3.7%, a 48-year low. Meanwhile, Apple plunging into correction territory today, posting its worst day since 2014. The tech giant announcing strong earnings for the fourth quarter, but issuing weaker than expected guidance for the end of the year. The company also said it will stop reporting individual unit sales of the iPhone, iPad, and Mac starting next quarter, Apple dipping below its historic $1 trillion market cap thanks to the drop. And Starbucks shares surging 10% today on a pickup in U.S. sales. The company reporting yesterday after the bell that U.S. same-store sales grew 4% in the fourth quarter. Starbucks reward members driving nearly 40% of sales in the U.S. That's the action from the U.S. market. Back to you in Mumbai.
All right, so that was the action from the U.S. markets, but some macro cheer coming in for Wall Street from the October employment report, which is coming stronger than expected. So the U.S. added about 250,000 jobs in October, the last jobs report before Donald Trump's first midterm elections, which kickstart on the 6th of November. The wages were 3.1% higher in September than they were a year ago. And in September, the unemployment rate fell to 3.7, which is a 49-year low, and remained there in October. The U.S. has now added jobs every month for 97 months in a row. This is the longest run of job gains on record.
Okay, well, let's go across to Steve Leesman now with all of the details on that job report.
It was a strong report, and you kind of turn it sideways and look all the way around, all the details, very little weakness in it. Two questions, though, raised by it. Did it get a little bounce from the snapback from Hurricane Florence in September, which would still leave it to be a strong number, which raises the second question. Can this strong momentum continue? Here are the numbers and the context. 250 on the payrolls, but we're looking for 188. Average hourly wages, 0.2%. And it's the year over year that President Trump actually remarked on being 3.1%. Unemployment rate, 3.7, unchanged. Labor force participation rate, up 0.2%. Here's the year-over-year chart on wages. You see we haven't been here since the financial crisis. So you have that nice steady rise, and we'll see if that can stick around and you can get employees getting a raise that has to do with both their productivity and the inflation rate, so they can keep pace with that and their standard of living can rise. RSM says, quote, the primary narrative with respect to the labor market dynamics over the next year will be wage growth and the ability of firms to manage an historically tight labor market amidst a strong U.S. economy. And then you can see that there were jobs across a slew of sectors. I think every sector actually saw job growth, 44,000 in education, health services, leisure, hospitality. That's where you might have had a snapback from the hurricane, up 42,000. But manufacturing and construction both strong there. The next thing that was out the other way, Oxford Economics, these encouraging readings suggest very little slack left in the labor market. And that's going to be the concern for the Fed. How low does it let the unemployment rate go before beginning to seriously, guys, lean back against the momentum? I've heard calls 3.5%, 3% by this time next year on the unemployment rate.
Okay, well, on that note, let's get in some expert opinion on the stronger than expected October employment report as well.
This is a strong report. It's not surprising. We've had two very strong back-to-back GDP quarters, and jobs follow GDP with a lag of 1 or 2 quarters. But this will keep the Fed on track. I mean, we've now got real wage growth for the first time in a long time, and that's a reason for the Fed to tighten in December, keep on tightening in March and June of next year. So I think this is not a good report for the bond market, but it's a good report for the economy. Equilibrium is when wage growth is stable. When you've got things actually too strong in the economy, it's when wage growth is rising. Now, it's nice for workers, but the Federal Reserve has to actually push against that a bit. So I think this will encourage them to keep on tightening, to get to a more neutral stance on monetary policy, because frankly, it's still pretty accommodative. They're still feeding this growth in the economy. We've got over 700,000 people added to the labor force. That's 1.4% year-over-year growth. That's great. It's not likely to be sustainable. We've actually seen declining immigrant visas for a third year in a row here. So we're gradually seeing a labor squeeze here. And one of the things I do worry about after the election is if we get, say, tax cuts 2.0 or a big infrastructure bill, we really don't have the workers to handle that. So I do think this labor market's tightening. We didn't get that in a full in the unemployment rate today, but I think that's coming. And I think the Federal Reserve will be a little bit worried about that. I think they're on track to tighten in December.
Labor market healing has continued. We've been seeing it in the employment numbers. We've been seeing it in the unemployment numbers. We've been seeing it in various surveys. And I think the wage numbers was probably the biggest laggard in all of that. And that's much less true now. It's also not just the average hourly earnings numbers. but also the employment cost index, which came out a couple of days ago, which also showed an acceleration to the fastest pace. So right now, I think we are at about 3%. We'll see some further updrift. Now, the Treasury market is a very large, very global, very liquid market. So I think demand for long-term US bonds from outside the United States will continue to be important. There are some big differences between where different economies are in the cycle. Europe's well behind, EM's well behind. So I think that will continue to weigh on treasuries, on treasury yields. But on net, we do think that we'll probably move up somewhat further to the 3.4% or so range.
Right, and across the Atlantic, the European markets ended mixed on hopes of a trade agreement between the US and China. The German DAX ended about 0.5% higher, followed by the French index that also ended about 16 points in the green. However, the FTSE was an underperformer, ended about 20 points lower at close. Across the peripheral indices, though, we saw flat gains coming in for the ATEX, while we saw a big amount of outperformance coming in from the Italian index, which was up by about 1%. However, in the emerging market space, the Russian index was also in focus, up by about 0.3%, as was the Brazilian index. But the big cue will be crude oil prices. They've fallen as the US sanctions on Iran have kicked in. Manisha Gupta now joins us with all the update. Manisha, like the Donald Trump tweet said, sanctions are coming.
Oh, clearly, and they are, and they have. The U.S. sanctions on the Iran have kicked in, and the U.S. has also said that they will add 700 individuals and entities to its Iran blacklist. They would also pressure the global SWIFT banking network to cut off Tehran. Though, of course, 8 countries, as we understand from various reports, have been allowed to continue Iran crude imports under temporary waivers for a limited time. And India does feature on the list, is what we are made to understand. There are plenty of things happening, but just to talk about the numbers right now, there is an expectation that Iran exports of some 2.5 million barrels per day that we have seen right now will plunge to 1 to 2 million barrels per day when the Iran sanctions actually take on. So those numbers is something that we will want to watch out for. On the other side, of course, the OPEC heavyweights like Saudi Arabia and its partners are standing ready to pump up supplies, even as the market conditions do remain uncertain. Remember, there are outages still on in Libya, Venezuela, Nigeria, Mexico, and Angola, etc. And that would really force Saudi Arabia and Russia perhaps to increase production, and that would mean that the spare capacity in the global markets would come down quite considerably. So yes, we are in a situation of uncertainty here. Markets would want to know on what numbers are we getting in on here. There is this winter demand coming in. The refinery maintenance would come in as well. And the U.S. shale output, while of course it is on the higher side, the infrastructure, the bottlenecks, etc., is something that we would want to watch out for. As of now, of course, the kind of correction and on the sell-off that we have seen in crude oil prices does come in on the fact that there are supplies increasing from US, from Russia, from Saudi Arabia, etc. But how much, how long can they continue to hold on to those levels is something that the investors would also want to know.
Okay, all right, Manisha, thanks very much for that. In fact, we have Jonathan Barrett joining in of Probus Securities to just talk about what his view would be on the Iranian sanctions. Jonathan, hi, morning. So what is your sense? Because we've seen a huge correction come into crude prices. So is the sting taken out of the sanctions, according to you?
Good morning. Look, it seems that the market really is suggesting that any real concerns are not really there because the price is under pressure. I think the balancing is that investors and traders are saying that, well, if the global economy is under pressure, then we don't need that supply. And with Iran out of the equation, it doesn't create too much of a hiccup. So I think the market's telling us that there is more capacity in the market, and as a result of that, prices are under significant pressure. Remember, oil prices have come off 17% in October with the proposed for these sanctions to kick in. So it is quite interesting to see that the market really hasn't taken on aggressively that will have a concern in capacity.
Hi, Jonathan, thank you so much. So what is your sense really in the global markets right now? What would you say it would mean for a consumer country like India right now? Because we understand that the waivers are temporary for a limited time. Where do you see India now exploring newer markets from?
Well, look, I think let's see what the temporary waiver and how that affects things. I think if the capacity is there, then it shouldn't be too much of a problem. Remember that where market is concerned about that capacity and where it'll come from. But I get a sense, and this is what I'm really focused on, is how the US is really going to react to the fact that Iran is still producing and exporting, and also how the US is going to react to those countries such as India and Japan and China who import oil from them. So when I look at it, it's going to be quite interesting. I guess the market price has told us that they're not too concerned, but let's see what Trump actually has to say over the next 24 hours, because I think that's a litmus test for the direction for crude oil over the next week, 2 weeks.
Absolutely. So in that sense, where do you see then the year ending, especially for the crude oil prices?
Well, the interesting thing, when you look at Brent is right on support. Around that $70, $72 a level. I think the market has gone under considerable pressure. I'd sense that when we had the unemployment numbers out of the States, which were higher than expected, you get a sense that the global economy perhaps isn't as negative as what people are expecting. So I think we potentially find a low around here. Wouldn't probably see prices lift up and probably settle around that $75 a barrel towards the close. I mean, we've had a great sell-off, but I think from here should be some support whilst we have that Iran situation in play.
All right, $75 per barrel is where Jonathan sees crude settling towards the end of this year. But in light of all the cues that there are on the table right now, what would your asset allocation strategy be? How much would you allocate to developed markets? How much would it come to the emerging markets? In the emerging markets, what would your pecking order be? And in light of the rising US interest rates, do you think debt is where one should be?
I think when you take a cross-section of where, I mean, I sort of tend to focus more on the base metals, and you can see that they've been under an awful amount of pressure. You've still got those issues in trade, which we haven't resolved. So I guess when I look at my allocation, I do like looking at the bond market because it's stable and it's stable yield. When I look at the commodity markets, I've always liked copper, and I also feel that gold is certainly, a lot of people are underweight in gold. So I guess when I look at it, the main standouts for me would be sort of some of the base metal markets because they have been underpinned by the concerns, particularly copper, but I also like a look at sort of the precious metals when I look at gold and particular silver going forward because they've been really, nobody's focused on them for quite some time.
Okay. All right, Jonathan, we're going to let you go on that note. Thanks very much for joining in and taking us through what you think would be the impact of the Iranian sanctions. Currently, Brent crude at around $72 per barrel. On that note, let's in fact listen to what Mark Keenan of Societe Generale had to say about that as well.
The big shock, frankly, last week was the imposition of these waivers extending to 8 different countries. Remember back in May, June, July, when these sanctions were first talked about, Trump was very clear that output was to go to zero, Iranian exports would be zero, and there would be no option for any waivers in any capacity. So this has come as a little bit of a shock, and prices have weakened a little bit more at the end of last week, following what has been a pretty significant sell-off in the oil markets following the equity riot in October. So we're down around 17% since the peak at the beginning of October. And now we need to see how the trade war evolves, very much so. We need to see how the market takes the Iranian sanctions this week and what the waivers mean, what the details of the waivers are. We expect prices down into the 70s for Brent next year. And at about $5–6 lower on WTI. Our main reason for that is, as I said, the emergence of, or the ability to get the oil out of the US. because the pipelines will be completed by that stage, and a little bit of a slowdown in global growth. Our economists are talking about the majority of the slowdown is coming from developed markets. In terms of India, China, oil demand growth is still stable to decent, specifically in places like India. Despite that, however, factoring that into our supply-demand balances, we do see lower oil prices next year, and that's reflected very well in the forward curve as well.